Hello, everyone, and welcome. Just recently, I posted something about a trip I'd made to Harare, capital of Zimbabwe, to present a course on ALM at the bank there, and I observed some particular characteristics of the market there, which is not untypical of what I'm going to call frontier markets for the purposes of this video. Emerging market economies where the banking market or the financial markets are not necessarily as developed as one might observe in G7 currency economies. And I had some feedback back saying, okay, so bank ALM, it's a universal discipline applied in banks for the last 500 years all around the world. But are there any particular things we should bear in mind if one is practicing the discipline in a frontier economy? So I'm going to use that expression for emerging market economies. And I've put together a very short presentation just to introduce the topic today, only a few minutes today. We can develop it in greater depth later if there's any interest. So first of all, if you look at the slide there, frontier markets exhibit certain characteristics. With respect to the local currency, their own jurisdiction, there's not necessarily a standard or transparent market benchmark reference rate, for example, an equivalent of Euribor or SONIA in the UK or SOFR in the US. There is little to no developed wholesale or interbank funding. Where there is interbank funding, it's often the case that one would observe that up to very short tenors, perhaps overnight or 1 week, which again impacts the funding capability in wholesale markets, but also reference points for longer dated borrowing. There's certainly unlikely to be a derivatives market, or if there is, limited to FX forwards and non-deliverable forwards. And that there is often a higher share of balance sheet assets that are sovereign assets, the local sovereign authorities issuance. Now, in the foreign currency market, because of course often particularly larger banks in frontier economies are dealing cross-border business, they will have a share of their balance sheet that's in liquid G7 currency. So, for example, dollar, sterling, euro. Now, these two features in both the local currency and the foreign currency make the practice of ALM a little bit more asset liability management a little bit more challenging. In effect, if you consider one legal entity, the bank is essentially running two separate balance sheets in the same legal entity. So we're going to look first very briefly in liquidity risk, where for the G7 currency part of the balance sheet, and we'll also look at how one might construct a yield curve for the local currency as well. Now, as I said, this is just an introduction to the subject. I'm not going to go into any great detail because this is meant to be a very short video. Right, first of all, liquidity risk. The one thing we have to bear in mind is that in these economies, there is essentially no lender of last resort. The central bank in that jurisdiction can't be considered to be a lender of last resort for the foreign currency of any particular banking institution. Now, in practice, one might observe in severe currency crises that the government will step in and the central bank will step in. But of course, as bank managers, we can't really rely on that, because in essence, that's an existential crisis, and the bank is essentially being bailed out by the government, which will pretty much mean the senior executive probably out of a job. So as ALM managers, we don't want to get to that state. So we operate from the view that there is no lender of last resort for G7 currency liquidity stresses. That would suggest to me that the liquid cash ratio, which is a metric that I introduced last year, or post Silicon Valley Bank, an LCR type measure, but with some slight adjustments. That's for another day, perhaps. I presented the liquid cash ratio as a metric last year. That metric, or an equivalent survival days measure, becomes really important when managing liquidity risk for the foreign currency part of the balance sheet. Let's have a look at my suggested one-pager for the board and the ALCO. So the ALM one-pager, here's my suggestion of how you might want to format that. On the top left, I've got a surplus cash measure. Now, that is essentially, well, it's a bit like liquidity coverage ratio, the Basel metric, but the denominator is your own worst case scenario stressed outflow in the foreign currency, and the numerator is your actual cash position in that foreign currency. So cash, not necessarily the central bank, hence it can't be a true LCR, because in the Basel LCR metric, bank assets don't count as HQLA. This would be considering your holdings of that G7 currency in other banks, for example, systemically important banks abroad, because there's no lender of last resort. So the surplus cash measure, or your liquid cash ratio, as I've called it, becomes very important when we manage the balance sheet on the basis that there's no lender of last resort. So that's the first thing to consider. Now, again, a typical balance sheet in frontier markets shows a large share of sovereign assets alongside customer loans, and essentially completely customer funded. The non-equity liabilities side of the balance sheet structure will be customer deposits. That means we don't have any market reference points when we're looking to construct a yield curve. And again, what did I say at the start? There isn't a recognized benchmark reference rate that we can look at, an equivalent of Euribor or SOFR, for example. So what might we look to consider? Well, the kickoff point, of course, is our funding base. Now, let's just take one step back very quickly. Why do we need a yield curve for all those things? But actually, this is my friend Polina's slides here. Those things don't apply in this frontier economy. So I'll put a line through that, and I'm going to go on to the next slide, which says basically, what are we doing? What are the challenges we face if we're looking to construct a curve in a frontier market? First of all, as I've said just now, there's no interbank market, or if there's it's very short tenors. There's no wholesale market as such. I don't have any reference rates to look at, and I've got no derivatives to underpin any curve construction. So that makes constructing my internal funding curve a bit challenging. Where do I start? Well, essentially, I've got two sources, okay? First of all, before I come to the two sources, very quick slide there, we should look at the liability side, because I'm looking at the liability side. I'm looking at my rates on the liability side, as well as the yields on the asset side if I'm holding government bonds. But that's the government's funding rate, okay? The assets, the yields that I'm getting on government assets, that's the government's funding rate. So if we take these two factors in, we've basically got a curve that starts, a baseline curve that starts with my deposits cost, what I'm paying for deposits, and then what the government is paying for its bonds. Now remember, that's the government's funding curve. It won't be ours. Our customer rates might sit below that, particularly in instant access deposits, but for any longer dated deposits, it won't. Of course, bearing in mind, assuming there are longer dated deposits around. In some frontier economies, the concept of, say, a 1 year or 2 year or 3 year term deposit is unknown, as is the concept of a notice deposit. For example, a 30, a 90 or a 60-day notice deposit account. These are unknown. Essentially, we're looking at overnight call type deposits, instant access, or potentially very short-term fixed rate deposits, say 1 week, 1 month, 3 months. So we've got two sources of information. We can use those to construct the curve, okay? And that's what that slide is saying there. We've got deposit funding rates, which won't go out to very long tenor. Certainly I'm thinking not beyond 1 year, possibly not even beyond 3 months. And we've got sovereign bond yields. Can we use the two of them to construct a yield curve? Yes, by blending the two. Okay, we might start off with our retail rate, which is reasonably low, out to the maximum tenor we take, and then we will splice on the government yields to that, but that's the government's rates, which may or may not sit above our funding rates. Generally, once you go beyond 1 year, the government rates will be, whereas we're only paying for very short-term deposits. Now, that leaves me one last ingredient to throw into the pot. Could we take a behavioral tenor of our customer deposits and use that to construct our curve? So we might have deposits for customers that are instant access in contractual maturity. Perhaps we might even have a 30-day deposit that we offer them. But beyond that, nothing contractually long dated. But could we take a behavioral tenor? What if using our observed statistics, the behavioral tenor of that deposit, the call deposit, is actually on average, let's say 1 year, or there's a core part of the balance that stays around for more than 1 year. Could we take that as our 1 year rate? Why not? That's very common in developed markets. Should we consider it in frontier markets? Well, I don't see why not, because we're making an assumption that some of our customers will be reasonably stable in terms of their behavioral characteristics. Until, of course, there's a stress event or there's loss of confidence in the bank, in which case you'd probably like to see funds going out quite quickly. That, of course, then we're in an existential situation. And to quote a former deputy governor of the Bank of England, in the most extreme scenario, possibly no amount of liquidity reserve or indeed capital reserve will be sufficient to save you from going under. So I think I'm going to stop there. I was really just introducing these two topics to get the conversation going. I welcome your comments after you've seen this video as to how one should practice ALM discipline in frontier markets. To me, all of the foregoing argues strongly for one overarching principle, and that is a conservative approach to ALM practice, which we we ally with our own judgment based on our experience acquired over time. I think ultimately, when there isn't things that one might take for granted in developed economies, like a transparent reference rate, liquid and observable wholesale markets, long-dated, contractually long-dated customer deposit funding, when these things aren't around, then essentially when one is practicing ALM discipline in a bank, one is being very conservative in applying it. Okay, right. I will stop there. Thanks for listening. I appreciate and welcome all comments of having watched this video, and I'll speak to you soon. Take care. All the best. Bye-bye.
Thank you for watching this video. Please have a look at my YouTube channel and subscribe and watch the videos on that one. I'm sure you'll enjoy them. Thank you.